From National Review headquarters in New York City, this is a Capital Writing author interview. Our guest today is Scott Hodge. Scott is the author of the new book Taxocracy, and he is the president emeritus of the Tax Foundation, Washington, D.C. based think tank that does tax policy 24/7. Thanks so much for being here, Scott.
Well, Dominic, thank you for having me. And it's really nice to see a Tax Foundation alumni do as well as you are. And it's been fun watching your career, and your writing is, of course, fantastic, very engaging. I wish we could say we taught you everything you know, but that's not true.
Well, I appreciate it, Scott. Yeah, I was a Tax Foundation intern
Yeah.
when I was in college, and so yeah, learned lots of great stuff about how to think about taxes like an economist. And this is sort of a really good introduction to your book, which is very much trying to get people to think that way. I think most people think about taxes as taxpayers, which is totally understandable because most people are taxpayers. A lot of people also will think of taxes in terms of politics. They'll think about it in terms of what will help me win votes, or what will help to make the budget look balanced, or what will help to game the budget scoring rules. People think about taxes that way,
Yeah.
but thinking about taxes like an economist is really something different. So, if you could kind of explain, just to start off, what that means to think about taxes like an economist.
Well, it really means to look at the consequences of tax policy, how taxes affect not just our behavior, but the economy overall, both on the macro level, the broader economy, but the micro level as well. How it changes incentives for people, how it makes us do things wouldn't necessarily otherwise do. Now, economists tend to look at taxes in sort of math terms, if you will. They're really big on supply and demand curves or mathematical equations to try to figure out the effects of tax policy. And a lot of my colleagues here at the Tax Foundation do that. We have a very sophisticated model to look at the effects of tax policy. But I've always loved stories about tax policy. And I think that every tax can tell a story. Lawyers always talk about, signs. There's a story behind every sign. So, why do you see a sign that says warning? Well, probably someone electrocuted themselves, and so the lawyer stepped in and created a sign. Well, every tax can tell a story about unintended consequences, because lawmakers have often one thing in mind when they enact a tax. Oftentimes, it's just simply to raise revenues, but there's often an unintended consequence that comes from those policies that the lawmakers really never thought about and should have. And there are a ton of examples like that, both from history and then currently. And what I've tried to do in the book is share some of those examples, but take the lessons from those and apply it to our current tax code so that people can have a better understanding in their own terms, sort of layman's terms, the impact of these tax policies. But then ultimately, what I've tried to do is provide uh, some advice on how to change things, improve the tax code so that it can take the tax code out of our lives, allow us to go through our daily lives without having to think about taxes, which too many of us have to do.
So you called the book Taxocracy.
Yeah.
Obviously, a democracy would be rule of the people.
Yeah.
Taxocracy would be rule of taxes.
Yeah.
You just sort of were mentioning how the goal of the book and the goal of a lot of the work that you do is trying to get taxes out of people's lives. What does it mean to be in a country that is ruled by taxes?
Well, we're in that. In many respects, the tax code sort of takes efficacy away from us, takes self control away from us, because the tax code is trying to get us to, oh, buy a home and use the mortgage interest deduction, give to charity, um, uh, even buy an electric car, quit smoking, drink less. You go through all of these taxes that are in the tax code, and they're really aimed at some aspect of our daily life or our activities. They're either trying to encourage us to do something or discourage us to do something. And as a result, that takes away from our self autonomy and really puts us in the hands of political decision makers. And if we move toward what economists call a neutral tax code, one that treats everyone equally, has a level playing field, doesn't discriminate between one product and another, we can get back our autonomy, we can get back our self control, and we can get the politics out of the tax code.
And this doesn't necessarily mean taxes will go away, obviously. We still need taxes to fund the things that we want government to do, but it's more about shifting the focus of taxation away from encouraging or discouraging behaviors and towards actually raising revenue, which is what taxes are supposed to be about.
Mhm.
What are some of the other things that a good tax code does? I know you list four different things in the book, four different qualities of a good tax code. What are those?
Yeah, well, the first, as I mentioned, is neutrality, and that is the taxes should have a level playing field, treat everybody and every product and every activity the same, so that no one can game the system or use the tax system to punish certain types of behavior or people. Simplicity, we want a very simple tax code that is transparent. That's the third aspect of a good tax system, so that we should always know why we're being taxed, where the money is going for, and what it's being used for. And then, lastly, we want a tax code that's stable. Far too often, we have taxes that come and go. You look at the Bush tax cuts, they didn't last 10 years. And then Obama had some tax increases, and those got changed. Our most current, the Tax Cuts and Jobs Act, which was passed in 2017, is now about to expire next year. And so we're going to go through more upheaval. And so we have this constantly evolving tax code that we're trying to adapt to. And it's particularly hard for businesses to be able to predict and make decisions for the future when you have a tax code that's so uncertain.
You mentioned in the book a famous quote from a former Treasury Secretary saying that it would be nice if we just had a tax code that looks like it was designed by someone. It looks like it had some kind of purpose behind it.
Yeah.
The way that the tax code is made is through legislation over many different years and many different Congresses, and they sort of pile things on top of each other in ways that don't make sense a lot. Can you talk a little bit about some of those contradictions that we have in our tax code, where even the politicians who disagree with you and think that we should use the tax code to encourage or discourage behaviors, we actually end up doing the opposite or doing things that are at cross purposes with each other?
Well, you look at things like, I like the kind of taxes that are intended to stop certain behaviors. And lawmakers can't really decide whether this tax is intended to raise revenues or stop you from doing something. And that concludes, say, smoking, for instance, where the idea is that if we tax this product, people will use less of it. Well, but we wanted to use that revenues for this kind of, let's say child nutrition or daycare or something like that. We've seen this with sugar sweetened beverage taxes, for instance, which Philadelphia famously raised their tax to equal that of beer. People actually, it was cheaper to buy beer in Philadelphia for a while because the tax on soda was so high. So as a consequence, people went across the border to buy their soda. Soda revenues collapsed, and that revenue was supposed to go through, for child poverty programs or something like that. And so there was less revenues for that. And you see the same thing with things like wealth taxes, where the whole idea is to raise revenues by taxing wealth. Well, are we really trying to tax wealth and get less of it, or are we trying to raise revenues in order to pay for something else? And those are the kind of contradictions that we see oftentimes in policy, where lawmakers really can't figure out what they're trying to do with it.
This is one of those funny cases where conservatives usually get, if a conservative is a person who is hesitant or resistant to change,
Yeah.
it would be weird to describe this book as conservative because there are lots of things that you want to change about the tax code. We look through not just sort of the standard examples like the soda tax that you mentioned, which a lot of people know about and it doesn't work. Things like sin taxes and things like that. But you even go after things that are really, really popular, like the charitable deduction.
Yeah.
You've worked at a 501c3 organization for a long time.
Yeah.
I work for one right now. We benefit to some extent from the charitable interest deduction or the charitable contribution tax deduction,
Yeah.
but why is it actually not very good tax policy?
Look, I wouldn't be honest if I wasn't in this position and not challenge both the charitable deduction and the whole idea of charitable organizations or nonprofit tax exempt organizations. And I, but actually, this book's really encouraged me to start looking more into that. And the tax exempt economy, if you will, is about it's over $3 trillion now with all the different kinds of entities that are now tax exempt, and a lot of those organizations or activities were made tax exempt in the first income tax, which was passed in 1894. It was later repealed because of the Supreme Court, but then embodied into tax policy in 1909. It reflects really a 19th century sort of communitarian idea of what nonprofits should be. Well, today, you wouldn't believe well, we're in the middle of March Madness right now on basketball. Well, guess what? The NCAA, which earns about $1.2 billion a year in TV revenues, is a nonprofit. It's an educational organization. Come on. And and it's a sports entertainment network now, but it's doing it under the guise of being nonprofit. And then we have the Pro Golfers Association and all these other organizations that are essentially businesses masquerading as nonprofits. And I think we ought to challenge that and decide what's the difference between that organization and a truly benevolent organization that is there to help people in need. And we ought to be able to focus the tax system on those people and not benefit those that have become big businesses. And then for the charitable deduction, which of course, being the head of an organization for 22 years, I've raised millions of dollars. On the other hand, the charitable deduction largely benefits the wealthy. Just because the nature of any sort of a deduction, the only way that you can really benefit from the deduction is obviously take it, but you have to have a tax liability in order to take the deduction. The more you pay in taxes, the more you benefit. The higher your tax rate, the more you get for that benefit. And so it really is inequitable through our very highly progressive tax system to have a deduction like that. And to be honest with you, the more you look at the economics of the charitable deduction, charitable giving rises with the economy and not the benefit of the charitable deduction. People feel more charitable when the economy is doing well, when they feel have more take home pay. And so you have to really ask people this question: would you rather pay higher taxes and get a charitable deduction, or pay lower taxes and not have it? And that's one of the things that I've actually challenged rich people to think about. I can raise the value of the charitable deduction today by raising the top marginal rate to 50%. Now, would you rather get a savings of 50 cents on every dollar you give to the Tax Foundation or to National Review? Or would you rather have lower taxes, more freedom to decide how you'd like to use your own income? And that's the decision we need to ask people to make.
Yeah, the point that you make about deductions and about tax credits, I think, is really important. I think it's something that a lot of people miss, which is that for roughly the bottom half of taxpayers in the United States, and again, that's the median all the way down to the lowest end.
Hmm.
They have very little tax liability to begin with on the
Yeah.
individual income tax. Obviously, they pay payroll tax, they pay sales tax to their state, they do all of those other things. But on the individual income tax at the federal level, they have very little liability. And so when you talk about a tax deduction or a tax credit for someone who has no tax liability to begin with, that doesn't do anything for them. Who it does do a lot for is people with lots of tax liability who are wealthy people. So when you have politicians that are proposing tax credits or tax deductions for the middle class, well, they're not really going to be the people that are taking the deduction.
No, indeed. And so you look at things like the home mortgage interest deduction. Well, it tends to benefit upper income people who have more expensive homes. And by the way, a lot of the times these kind of deductions get built into the cost of the things that you're buying. So the home mortgage interest deduction gets built into the price of the home. And so what that does is oftentimes price lower income people out of home buying while benefiting higher income people. Another good example of that is all the credits for higher education. So we've now passed lots of various types of credits and deductions for people for tuition and books and so forth. Well, what the universities have said is we'd like a piece of that too. And so they've raised the tuition or they raised fees and other things in order to capture those tax benefits that we think that we're benefiting from. We end up paying a higher price and they end up getting the cash and we feel better because we think we got a deduction. It's kind of like going into oh, I don't know, Neiman Marcus with a 10% coupon. We think that we're going to benefit, but actually we're still paying a higher price than we would otherwise. Electric vehicles are another good example. Who's really benefiting from that $750 tax credit to buy an electric vehicle? Number one, electric vehicles are very expensive. They're only being bought by upper income people. But are the car manufacturers absorbing that credit, or do we really benefit from them? And I think to a large degree, the manufacturers have actually built the value of that credit into the price of the car. So they're the ones that are really benefiting from it, not buyers.
Another instance of sort of bad distributional effects of taxes that you mentioned is about tariffs, especially on clothing. And it turns out that tariffs especially affect children's clothing and clothing for women more so than for men. Can you explain how that works?
Yeah, we've heard about the pink tax, which is kind of this mythology around the fact that a lot of women's clothing or cosmetics or personal hygiene products are more expensive than men, like the dry cleaner. Why does this dress cost twice as much at the dry cleaner than my suit? Uh, but there's more to that story than just those kinds of examples. And we see it in tariffs, where originally a lot of tariffs, let's say for clothing in general, over time get focused on certain kinds of products. And what we've seen over and over again is that women's products in particular end up facing a much higher tax burden or tariff burden than men's clothing. And for various reasons. One, they tend to come from countries or made in countries that we don't have tariff safeguards with. And for some other reasons, it has to do with the design of these clothing. And we see it in other cases in which I've got a great example in the book about value added taxes, for instance, in which you have children's clothing in the UK that are zero rated, meaning the value added tax is not applied to children's clothing. Well, turns out that children's clothing goes all the way up to like age 17, and so you see petite women going in to buy children's clothing or teenage clothing, and thus saving on their value-added tax. So we see all kinds of distortions with things like that in the tax code. Anytime that you tax certain things one way and other things another way. The tariff examples are a lot of fun where we see what we call tariff engineering, where manufacturers have become very adept, clever, and amazingly clever in slightly altering the products to avoid the tariff. And the great one is the sneakers, or the tennis shoes that are imported with fuzz on the bottom, and that way they qualify as bedroom slippers, which don't have the tax tariff applied, and not tennis shoes, which do face a higher tariff. We've seen other cases like we can talk about the chicken tax, which forced manufacturers to import automobile or actually delivery vans in parts, reassemble them here in the United States to avoid this higher tariff. And the bottom line is that taxes, tariffs, other things make us do things we wouldn't normally do, but they also make us very, very clever in trying to avoid them.
Yeah, one of the issues that you talk about in terms of defining what counts as being taxed is that it creates these existential crises with certain goods and products where either bureaucrats or companies have to be like they have to be Plato and try to figure out what the ideal form of a cookie is instead of a or no, the example you give of is about Pringles, right? That is a
Yeah.
Pringle is it a chip or is it a different kind of snack? Can you explain some of these ridiculous games that companies have to play? They usually get years in court trying to figure out what a product even is.
Well, that's exactly right. Anytime you try to define something, of course, the marketplace can change it. A good example here in the United States, for instance, is the hard seltzers, which are taxed like beer rather than alcoholic beverages. And there's a tax differential between the way beer is taxed and the way alcohol is. And so these hard seltzers, which are brewed like beer, end up paying a much lower tax and giving them somewhat of a cost benefit over some of these other products. And then, we, as you mentioned, we get into things like Pringles, which is a very famous case in the UK, in which snacks like potato chips and whatnot are taxed at a higher value-added tax rate than baked goods like biscuits. And so the existential question about Pringles was, since they're baked using, I would say, potato dough rather than actually sliced potatoes, was it actually a baked good like a biscuit, or was it actually a snack? Well, after a lot of litigation and very high costs for the manufacturer, the courts finally decided it was a snack after all because less than half of its product was actually potato. And but then you see other things. There was another big court case in the UK about marshmallows. So we have Ghostbusters coming back, but the debate there was: are marshmallows food or are they a snack? Well, they decided that ultimately is a food, and so it wasn't taxed. Here in the States, oftentimes a Hershey bar is taxed like candy, whereas a Twix bar is not. It's taxed like food or not taxed like food. Why is that? Well, a Twix bar has flour in the middle of it, which then qualifies as food. The lesson here is when you create these differentials, you encourage manufacturers to one, try to game the tax, and then two, try to lobby to make sure that their product is in the untaxed category. So we create these opportunities in the marketplace for these kind of distortions. One, ridiculous attempts to avoid the tax, but also the kind of favoritism, cronyism, just outright lobbying to try to get a product to qualify as something it may not be.
And so the solution to that, right, is to just broaden the tax base so that there is no beneficial treatment that you can get because, just everything in the category is taxed the same, right?
Mm-hmm. Yeah, and of course the same would go with income. We have these existential debates over things like carried interest or capital gains and other things. Well, the problem here is that we're trying to tax income, which then gets you into these big existential debates about what really income is, and then how do we tax it? Well, if we move to a different kind of system, a consumption-based system, you get into less of those kind of questions than you would when you're simply trying to tax income.
Let's talk a little bit about how taxes actually get collected because you devote a chunk of the book to those questions as well. We have the IRS, of course, is the agency in the United States that does all of this. They've been in the news recently within the last couple of years, getting a much bigger budget, being able to hire lots more employees to do the work of collecting taxes. We've all heard the stories about how outdated their technology is and about how bad they are about responding to taxpayer complaints or taxpayer requests for clarification or information about things. What is what is holding back the IRS from being able to be a more modern and a more effective agency to do this essential job of government, which is collecting taxes?
I think the real issue here is that members of Congress, our politicians, cannot decide whether we want the IRS to be a tax collection agency or a benefit delivery agency. And right now, it's tilting toward being a benefit delivery agency. We mentioned things like the child tax credit, which has now gone from being a $500 credit 20, 30 years ago to being over $2,000 today. It's partly refundable, which means if you don't have a tax liability, you still get that tax credit. There's a lot of errors in that program, much like there is with the earned income tax credit, which is meant for the working poor. And right now, we've asked the IRS to be a benefit provider and to do things that I don't think that it's really designed to do, whether it's like managing welfare programs or housing programs. Now it's managing transportation programs or electric car credits. It's now managing all these green programs that were put into the tax code last year. And you just keep going down the list. And we have now asked it to do the work of every other agency in government. It's not equipped to do that. And as a consequence, it's failing at a lot of its basic things, like simply collecting the revenues that we expected. So if we want to save the IRS, we need to dial back all the things that we're asking it to do. And much of the book is really dedicated to looking at all the aspects of the tax code that the IRS is having to do and simply not equipped to do. I mean, we mentioned the technology. In 1988, the IRS was given about $8 billion to come up with new technology to be able to manage the flow of paper tax returns. They are still working on this 40 years later, trying to come up with technology to deal with paper tax returns. And during COVID, they had a backlog of 24 million paper tax returns. After, I don't know how many billions of dollars of effort, they're failing on that. And I think you have an agency that's simply distracted. It can't focus on what it's supposed to do because it's having to do everything else.
Yeah, I always look at it too, and I see unionized public employees as well as being part of the problem here too.
That's right.
No, but I think it's totally right that what we have to do to solve a lot of these problems is just stop asking the IRS to do so much,
Yeah.
because ultimately, like you said, this is supposed to be a tax collection agency, not a benefit distribution agency, and running all of this through the tax code is sort of unusual, right? I mean, do a lot of other countries do policy this way of running everything through the tax code?
Yeah, that's a good point to make because we are unusual in asking our tax collection agency to do so much. Most other countries provide poverty assistance and other kind of family assistance, for example, through other means, generally through a normal government agency, and they're not asking that much from their tax system. We do more for low-income people through redistribution and all these other programs than do any other country. We actually, depending on how you define progressivity and redistribution, we have perhaps the most progressive tax system in the industrialized world, and certainly the most redistributive. And that really surprises a lot of people how much we do through the tax code to redistribute income from the top to the bottom. And we exceed everything that other European countries, for instance, that we think of as socialist, do. They simply don't do as much as we do through the tax code.
Yeah, I believe you mentioned in the book there's something like 200 different tax credits and deductions
Yeah,
that are available to people, and a lot of them overlap with each other.
right.
A lot of them are created for really specific, unusual things. You do mention though that there is a role for deductions and for tax credits that can be part of a neutral tax policy. So, can you talk about what a tax deduction that follows in these principles of neutrality would look like?
Yeah, I think there are really three. And the first thing is we don't want to tax people's piggy banks. So we don't want to tax your savings or your investment. Uh, Anytime you do that, you're shortchanging the future by essentially raising the cost of investment and undermine people's savings. And after all, most people save through after tax dollars. So this is a second layer or sometimes a third layer of tax on that income. Also, we want to make sure that we give businesses what we call expensing or full the ability to deduct the things they buy to make themselves more productive, whether it's machinery, a new building, the pens and paper that their employees use, and so forth. Our tax code is very limited in its how much it allows businesses to deduct their basic costs, and that raises the cost of investing in new equipment and productivity enhancing things that make their employees more efficient and more productive. And then lastly, we don't want to tax foreign in or the profits that companies make in their foreign activities because those profits are already being taxed by the country in which they are dealing with. And so to then punish those companies for taxing them again once they bring those profits back is yet another example of double taxation. And those are the kinds of things that we want to avoid. Double tax really in any form, and that whether it's through savings or investing and that sort of thing. So it's really important that we stay away from that level of taxation. Moving toward a consumption base is the way to do that, and that means simply not any. If we don't tax our saving, then anything we do tax, by definition, is our consumption.
One of the tax deductions that has been the center of attention in the last 5 to 10 years or so is the state and local tax deduction, which was previously you could write off your state and local taxes on your federal return under the argument that that would be double taxation if it was happening twice. That was capped at $10,000 per year as part of the Tax Cuts and Jobs Act. Some Republicans want to get rid of the deduction entirely. Is that a good deduction, first of all, and second of all, what is the argument for and against it?
Well, I would say the argument for those who say, well, it's double taxation because you're taxing your income at the state or the taxes that you pay at the state level, and you have the same dollars being taxed at the federal level. That's really not quite the case because you're buying a different basket of government goods with state and local taxes than you are at the federal level. So it's a very different thing from when a company pays corporate tax in Germany on its German profits, and then again has to pay U.S. tax on those same dollars. It's not. This is not the same kind of case. The state and local taxes pay for those services, government services, whether it's street sweeping or fire department services, and so really it's a different case of double tax. It's not double taxation. The problem is that states are very adept at using that deduction to pass along their tax burden to Uncle Sam. And we've seen that over and over. New York and California and others are very famous for that. But even local governments know that they can pass along higher property taxes to Uncle Sam, and in a way that they can actually create sort of enclaves for the rich by using the tax code or using property taxes to essentially price people out of their community, knowing that some of those property taxes are going to be absorbed by Uncle Sam. So there's a lot of unfairness that comes with a state and local tax deduction. And by and large, it's an inefficient way of trying to help state and local governments too.
So the Tax Cuts and Jobs Act limited those deductions at $10,000 per year. It also did a little bit of allowing expensing for
Yeah.
businesses. It did not do on everything, but it did it on some categories in investment and allowed 100% depreciation on those. It also went a long way to simplify the tax code, primarily by raising the standard deduction a lot so that more and more people can just take the standard deduction and they don't have to worry about itemizing all of their deductions and doing their taxes in that way. So those are all things that the TCJA did to sort of move closer to the tax code that you would like to see. What are some other areas in which the TCJA maybe came up short and could have been improved, and how would you approach those looking towards 2025 when a lot of it expires?
Yeah, a lot of that is on the corporate side where the TCJA created some of these international tax rules, which have very funny names like the Beats and Guilty and Fitty and whatnot. And all of those were attempts to try to tax some of the income that our companies make overseas or prevent them from shifting profits around to low tax jurisdictions. Those are incredibly complicated provisions that I don't think um, were really the right policies ultimately. Whether or not they raise more revenues is still questionable, but they certainly added a tremendous amount of complexity to the corporate code. Um, and then on the individual side, I think we still could do more to simplify the tax system and bring rates down. The Tax Cuts and Jobs Act did bring some rates down, and I think that that's a good thing. But we could still do more on that regard. Ultimately, you have to think about the Tax Cuts and Jobs Act. While it certainly brought us along, was not the kind of fundamental tax reform that many of us tend to think about. The more famous types of, whether it's the flat tax, the fair tax, and some of these other types of taxes, which really do go at the tax system in a very different way. So the Tax Cuts and Jobs Act was still working with the parameters of our current income tax and simply tinkering around the edges. In some cases, in improvements, and other maybe not. Some of us, I think, would like to go a little bit further and really think about what kind of a tax system do we need to take this economy into the next century. And I think we need a dramatic overhaul of that, whether it's flat tax or something else. We tend to think of the Estonian tax system as being the ideal. And it's like, no, most people can't find Estonia on a map, but it does have the most neutral tax system among the industrialized countries. Treats corporate income tax in a very neutral way. Corporations only pay tax on their income when they distribute it to shareholders, and they tax that at 20%. Individual income taxes, 20%. Their value added tax, 20%. You can kind of see a pattern here. So everything is being taxed at a relatively low flat rate with minimal deductions. And as a result, their tax administration department is very small because it doesn't have to work that hard. Most people can really file their taxes on their phone because it's so simple.
I think I remember you saying in the book it takes corporations just like they could file their
Minutes.
taxes before lunch, right? It's not a problem for them.
That's basically it. And meanwhile, many of our corporations have become profit centers because they're staffed and ordered away, in such a way to take advantage of all the credits to deductions that have been built into the tax code. And I think that we're going to have a hard time reforming the tax code as long as we have corporations and individuals, for that matter, who see the tax code as an opportunity to take advantage of it, to somehow change our behavior in a way to mine those credits and deductions and use basically profit from them. We mentioned earlier about people not being able to use various credits because their incomes are so low. Well, the same thing goes with a lot of our efforts to help green technology and other things. A lot of the companies that are getting these green tax credits are startups. So they don't have a profit right away, which means they can't use the tax credit or deduction that Congress put into those the green bills. And so as a result, what we've done is we've said, well, you can sell those to somebody else who can use them for deduction. So now we've created this cottage industry, and I liken it to payday loans, where you can go in and say, well, I can't use this credit, so I'll sell it to somebody else on 80 cents of the dollar. So he gets $100 worth of tax credit. I get $80 in cash. It's like, well, wait a minute. Is this really the way that we want to subsidize these technologies? And as a result, the wealthy people and big banks and so forth are seeing this as an opportunity to arbitrage these things and benefit from them. And they're the ones benefiting, not really the green technologies.
One of the things that's been villainized in the last couple of years is stock buybacks.
Oh,
Where
yes.
there's now a 1% tax on that from the so-called Inflation Reduction Act. You talked in the book. This is something I didn't realize until reading the book. Is that a stock buyback, we should say, is one way that companies distribute profits to shareholders. So they could give them a dividend, or they could buy back the stock. It's just that there's two different ways of doing the same thing. But you were mentioning that in the 1930s, Congress was passing laws to do the opposite, to basically punish companies for not distributing their profits to their shareholders, because at that time they were concerned that companies were hoarding their money and they weren't doing. But now we seem to be encouraging them to do that. What is that about, first of all? Because I think it
Yeah.
goes over a lot of people's heads, and it sounds like something that's very complicated, but it's really actually not that hard to understand. And what is with this change in attitude that we've had, where previously we were villainizing companies for not for not doing things like stock buybacks, and now we're villainizing them for doing it?
Well, it's another case in which lawmakers are trying to micromanage the business community and try to get them to do things that politicians think is important, but may not be so important for businesses. And what we saw in the 1930s is that, and as you mentioned, that the goal there was to force companies to pay dividends and not to collect or not to basically hold money in reserve or maintain their profits. And so companies, corporate managers would do dumb things like overbuy. They would purchase more capital equipment than they needed. They paid bonuses. They wasted money essentially. And so that tax at the time really became a tax on productivity because it made companies less productive because they were focused on trying to avoid the tax than they were on their actual businesses. And we may see some of the same things with the stock buyback tax, which is simply a way in which companies reward their shareholders. And particularly in a day and age in which you have a lot of stock compensation, so the more that companies reward their employees with stock options or stock gifts, well, that could dilute the amount of stocks out there. So the way that you combat that is to use some of your profits, and these are after tax profits, to buy back some of the stocks so you don't have the dilution that might otherwise be the case. Politicians really don't understand that, and they think it's somehow companies not paying their employees enough or not investing enough or so forth. And it's really a failure of them to really understand how the economy works, how businesses work, and ultimately they should be free to use their profits in the way that they'd like.
One of the things that's very striking about the evidence that you provide in the book is that this is really a lesson that governments just have never learned, and they've been doing this for hundreds of years.
Yep.
Is trying to micromanage things and then finding out that there are unintended consequences for that. You mentioned one of the famous examples being the window tax in the UK. Can you tell us, first of all, when that was enforced, and then and what were the effects of taxing windows on buildings?
Yeah, the UK is, oh my, it is a treasure trove of bad tax policy, and there are so many, it's hard to document them. But the window tax happened from about 150 years from the early 1900s or 1700s through the 1800s. And it was really an attempt to tax wealth because the more wealth you had, the more windows you had, or vice versa. The more windows you had, the wealthier you must be. And interestingly enough, the window tax was progressive. So you were taxed on a progressive number of windows. Naturally, when those thresholds changed, people would come in and they would either board up windows to hide them from the tax collector, or they would simply brick them over. Well, this attempt to tax the rich ended up hurting the poor because wealthy apartment owners and tenement owners would brick up the windows in these apartment complexes, and as a result, the tax became a tax on light and air, and caused a lot of disease within some of these tenements and other apartment buildings because people were simply shut out. And it just goes, as one of the economists that I quote in the book says, it just goes to show that any time that government needs revenues, even a bad tax can last for a long time. But it does tell us a lot about the implications of trying to tax the wealthy. And we see it over and over as these kinds of laws have failed and ultimately hurt somebody else, not the wealthy.
And again, the answer there is just broaden the base and tax people the same. You mentioned the flat tax as a possible outcome that many people have advocated. What do you see as the strengths to that and the weaknesses of that? I mean, we've seen a big move a lot, especially at the state level in recent years, towards the flat tax, where we've had places like Arizona have done it. Iowa is going in that direction. Georgia is going that direction, and a few other states as well. So, can you talk a little bit about the flat tax and what these states might expect to see in the next couple of years as they go in that direction?
Well, I'm delighted to see that so many states are moving in the flat tax direction. And having been an advocate myself for the flat tax for the last 30 years, it's a great trend that I hope will continue. I think it'll be much more difficult to enact a flat tax at the federal level because of how progressive our tax system is. As you mentioned earlier, the bottom 50% of taxpayers pay very little in tax whatsoever, which means that the rich are essentially paying the most in tax. So if we were to go for a flat tax, for instance, of say 20%, it would mean a big tax increase on low income people and a big tax cut for high income people. Obviously, that's politically untenable. Um, we saw that actually back in 2015 and 16 when some of the presidential candidates like Rand Paul and others came to us and said, "Hey, we want to do a flat tax." I said, "Great." So we modeled it out, and they said, "Oh my goodness, that's even as a libertarian, I can't advocate for higher taxes on the poor and tax cuts for the rich." So unfortunately, our highly progressive tax system is throwing a lot of uh, speed bumps in the way of trying to move toward fundamental tax reform. Because how do you undo this highly progressive, redistributive system that we have in a way that is politically palatable? It's going to be very, very difficult.
Would a move towards an Estonian style system face some of those same problems because
Yes.
they also have this like you said, it's very neutral, but that would mean that probably a lot of people on the lower end of the income distribution would probably see a tax increase.
Yeah, one way you could avoid some of that is to create sort of a family allowance or a higher standard deduction, if you would, and so you are essentially exempting still a lot of income from the tax code for low income people before they end up having to pay that flat tax. It doesn't deal with the amount of redistribution that we have through the tax code through these tax credits, whether the child tax credit, the earned income tax credit, and other things. Um, those are actually sending a lot of cash to low income people. And it's very challenging to move away from a system that essentially redistributes so much income from the top to the bottom.
And so, what do you see as sort of the next battle on tax reform? I mean, obviously, in 2025, we have the issue over the extension or the expiration of the Tax Cuts and Jobs Act, of the individual provisions
Yeah.
there. Anyway, a lot of the corporate provisions end up being permanent, but that's sort of the immediate tax issue to deal with. But looking beyond that, what do you see as sort of the next thing at the federal level that we could actually do that would be a move in the right direction, along the lines that you argue in your book?
Well, in particular, getting to the issue of expensing, allowing business to be able to fully expense the investments that they make in new plant equipment, technology, and so forth. Um, those elements of the Tax Cuts and Jobs Act are phasing out. Right now, Congress is trying to scramble to patch some of those up. The more that we can allow expensing to become a permanent part of the tax code, the better off the economy and I think workers will be because they'll have the ability to work with better tools. That's one. I do think we need to fix the savings system in America. Our tax system is very complicated when it comes to saving. We have 401ks, we have these kind of savings plans, we have Roth IRAs and regular IRAs, and we got all these. No, you can save now for education, but you can also save for this. We need a real simple system for saving, and there are other countries like the UK and Canada that have universal savings accounts, which is kind of the one-stop shopping for saving, allowing people to save into a single account and use it the way they want to do it, not the way politicians have said, my gosh, you have to sit down and put your savings into all these little buckets that we've created. That's crazy and inefficient. How do people they can't manage that. So we need to move toward that sort of a simple savings program as well. Those two things alone would do wonders for the economy and also for simplifying the system.
Yeah, the savings issue especially doesn't seem to me like something that would be really partisan, right? Like this seems like something that Democrats and Republicans could agree on. Like, regardless of what you think about what tax rates should be, everyone should kind of be on the same page that it's ridiculous to have to, like you said, have these politician created buckets that people have to put their money in. Do you see that as being something that actually has a possibility of achieving some bipartisan support and possibly moving through Congress that way?
Well, you would hope so. I mean, we need to call it the Piggy Bank Act of America or something, kind of a mom and apple pie. But the challenge is that there are some more progressive members who see some of these saving vehicles as being a tax dodge for the rich, and so they're always going to try to close some of those things off as just another way of trying to punish the rich. I think the more that we can move toward a simple universal savings account, you can avoid some of that and try to minimize some of the politics that go into these things.
People will say the same thing about expensing for businesses, right? That's just like a giveaway to corporations, and they already have enough money anyway. Why do they need this special privilege, whatever? Why is that? Why is that not correct? Why is it not a special privilege?
Well, I will ask them, is it a special privilege to be able to deduct the salary of your workers in the year in which you pay it? Because the tax code allows companies to deduct the cost of their payroll and simple things like pens, papers, and whatnot, basic tools. So if you can deduct the cost of your human capital, why shouldn't you be able to deduct the cost of the tools that make your human capital more productive? That's really what's at the essence here. It's not a tax dodge because the only way that you can use that deduction is by buying new stuff, buying new equipment, buying new tools, investing in your building, and so forth. And so that's why it's so important. And there's an equity issue here. If you can deduct the cost of your human capital, you ought to be able to deduct the cost of your physical capital.
Yeah, so that's a situation where you're moving towards neutrality, right?
Mhm.
Neutrality between human capital and physical capital in
Yeah.
terms of the tax treatment there. Um, So, like I said, the book is called Taxocracy. It's by Scott Hodge. It is fantastic. Yeah, there you go.
There's
Yeah,
the cover.
looks good, looks good. Yeah. No, this is like I said, it's a very good book. It's even a good book if you think taxes are boring because Scott brings so many different examples from history, whether it's from the UK with the window tax, all these various food cases trying to figure out what things are. And they're really good examples that show a lot of the insanity that comes about because of how complicated taxes can become. And so the answer is getting closer to a simpler tax code that treats things neutrally, that makes sure that we're not trying to socially engineer the country by the way that we tax or don't tax certain things. And that's really Scott's overall message, and it's one that is worth reading. So thanks so much for taking the time, Scott, and make sure and everyone who's watching, make sure go get the book Taxocracy.
It is available already for pre-sale on Amazon, and it hits the bookstores on April 9th.
All right, thanks so much.
Thank you, Dominic.